With the recent Fed rate cut here in the early part of 2020, one of the outcomes that you need to consider taking advantage of is the lowered mortgage interest rates. In this video, I'll use some hopefully simple examples to help you determine if refinancing right now could be right for your situation. Now, you definitely need to tune in if you have more than 15 years left on your mortgage, or if your mortgage interest rate is over 4%, or realistically even in the mid to high threes. And I'll explain why coming right up. Hi guys, my name is Zachary Schlecht, your personal finance coach. If you're new to the channel, my main goal is to help you win with money by gaining control of your personal finances. Since your home mortgage is the single largest purchase that you're likely to make in your lifetime, understanding how to navigate the different mortgage options out there is absolutely critical to your overall financial success. Now, if you haven't heard yet, the Fed rate was recently cut, which, to put that simply, just means that the Feds are trying to help stimulate the economy. And one of the major benefits to this Fed rate cut is lowered mortgage interest rates. Now, I don't think that this is enough of a reason to rush into buying a house, but I do think that for a lot of you out there, this is a prime opportunity to refinance your mortgage and save a boatload of money in the long run. Now, the first and main thing that you need to think about if you're considering refinancing is the trade-off of the upfront costs versus how much refinancing will actually save you in the long run. Then, the two follow-up considerations that you need to think about are: one, whether buying mortgage or discount points is a worthwhile cost. Essentially, is it worth paying an additional upfront cost for a lower interest rate? And two, the advantages of a 15-year or even a 10-year mortgage compared to a 30-year mortgage. And I love debunking money myths with actual math. So we'll look at if getting a 30-year mortgage and just making extra payments on that is the same, worse, or better than just getting a 15-year mortgage in the first place. And at the end, if you're like me and you already refinanced somewhat recently so you have pretty good rates, we'll see if you and I are missing out and if it's worth refinancing again so soon. I'll be using several examples throughout this video to help explain these points better, but please bear in mind that these are hypothetical mortgage amounts, mortgage interest rates, and refinancing costs, and I'll be doing some rounding in my calculations anyway since these aren't exact values. So make sure you use this video for educational purposes only. And be sure to consult your licensed financial advisor and or mortgage lender for your specific situation. So to start out, let's look at the primary considerations for even refinancing, which is always weighing the trade-off of the closing costs and additional monthly payments versus the long-term savings. For these examples, I'll use a mortgage balance of $250,000, and I'll only use the monthly payment amount of the mortgage itself, not the insurance or property tax, etc., just the principal and interest. So let's say you have 20 years left on your 30-year mortgage with a 4.5% interest rate. That means that 10 years ago at the start of your mortgage amount was around $312,000. Let's say you're interested in refinancing, so you shop around, which I highly suggest you do, and let's pretend you find a 15-year mortgage at 3% with $2,000 in closing costs. Sometimes it's possible to roll those closing costs into the cost of your new mortgage amount if that's something you want to do rather than paying those fees up front. So let's do that, which will make for a new refinanced mortgage balance of $252,000. Your current monthly principal and interest payment is around $1,580, and the new monthly payment will be $1,740, so the monthly cost difference is $160. Now, let's consider the lifetime cost of the loan from today onward. To do that, you take your current monthly payments times 20 years times 12 months, which gives us around $379,000. The lifetime cost of refinancing to a $252,000 15-year 3% mortgage is found the same way. So you take $1,740 times 15 times 12 to give you a lifetime cost of about $313,000. So refinancing and paying $160 more a month will save you around $66,000 in the long run. But what if you want to just keep your current loan and increase your payments? You could do this by either paying the additional $160 a month or by figuring out the exact amount it would take to pay off your mortgage in 15 years. Now, these sound like the same thing, but they're actually different figures, because paying $160 more per month will still take you approximately 17 years and 3 months from today to pay off your current mortgage, where it actually would take an extra $325 a month to pay it off in 15 years. So paying $160 more a month would give you a lifetime cost from today of $360,000, and paying $325 more a month would give you a lifetime cost from today of $343,000. So you can see that the math for this hypothetical example works out in the favor of refinancing to a 15-year mortgage. But the big picture of how this broke down and how these different options compare is going to be the same for any similar situation where the refinanced interest rate is lower than your current interest rate. So if you decide to shop around and you run your numbers and you talk to your mortgage lender and financial advisor, and you come to the conclusion that refinancing right now might be the best move for you, then something that you might need to consider at this point is whether buying what's known as mortgage or discount points is right for your situation. And all this basically means is that you can buy a lower interest rate. And it can sometimes seem confusing if doing this is the right thing to do, but it's actually pretty straightforward. Let's use the same example as before, where your mortgage balance is $250,000. And the best deal you find on refinancing is a 15-year mortgage at 3% with $2,000 in closing costs, where the monthly cost will be the same as what we saw in the last example, $1,740. But now, let's say this mortgage lender offers a mortgage point, which is 0.25% for $1,500, which means that you would be paying an additional $1,500 for a 2.75% interest rate instead of a 3% interest rate. So the monthly cost with a 2.75% interest rate would be $1,710. So the difference is $30 a month. So now to see if that additional upfront cost is worth that savings, you divide the $1,500 by the $30 a month savings to give you what's called a break-even point. And for these numbers, that break-even point is 50 months, or 4 years and 2 months. And this is the amount of time that it will take for that $1,500 upfront cost to pay off. And the other important consideration in buying mortgage points is the lifetime savings, or essentially how much are you benefiting after this break-even point. For this example, the lifetime costs are $313,200 for the 3% loan and $307,800 for the 2.75% loan, plus the $1,500 points cost, which will add up to a total of $309,300. So this gives you a lifetime savings for this example of $3,900 by buying the mortgage points. Now there's no right answer to whether you should buy the points at all. That's a decision that you have to make. But this gives you the tools you need to make an informed decision. Basically though, what it boils down to is deciding if the break-even point is worth it for your situation. Basically, do you plan to move or refinance before or around that break-even point anyway? If so, then don't bother paying for them. And is the lifetime savings over the term of the loan worth the additional cost? So that's the first consideration that you need to make if you're thinking about refinancing right now. The second major consideration to make is whether you refinance on a 30-year, a 15-year, or even a 10-year mortgage term. So let's compare the difference between the two more popular ones, the 30-year and the 15-year mortgages. The lifetime cost difference between a 15-year and 30-year mortgage can be staggering, and not just because 15-year mortgages tend to already have lower rates. To keep using the same example as before, a $252,000 15-year 3% mortgage would give you a monthly cost of $1,740 per month and a lifetime cost of $313,000, which you can see consists of $61,000 in interest. The same $252,000 mortgage, but over 30 years and at a slightly higher rate of 3.5%, would only be a monthly cost of $1,130. But the lifetime cost skyrockets to $407,000, which is an incredible $155,000 in interest. So I'm just going to leave that there for a second. Yeah, that pretty much speaks for itself. Now, two terrible, awful pieces of advice that are out there that you need to completely ignore are related to the tax advantage of a 30-year mortgage and the flexibility of a 30-year mortgage. If you are using the tax write-off of your mortgage interest as an excuse for getting a 30-year mortgage and probably even a bigger house as a result, then you need to watch my previous video on how taxes work, where I explain why this myth just doesn't add up. And the other very enticing piece of advice is to get a 30-year mortgage because it gives you flexibility, where you can make just the lower payment if you need to, but you can still plan to pay that extra amount. Let's see what that actually looks like. Taking the same 30-year mortgage and making additional payments of $610 per month will mean that you're making the same payments as the 15-year mortgage of $1,740. Doing it this way, you'll pay off the mortgage in 189 months, or 15 years and 9 months, and with $327,000 in lifetime costs. So if this is your plan, then for the exact same payments, it will take you 9 months longer and $14,000 more to reach the same goal. That's basically an extra $1,000 a year just in interest. And the bigger piece of this is that it's only true if you actually make those extra payments every single month. Every month that you slip, you get closer and closer to paying 2.5 times more interest over the life of the mortgage. And this is exactly what the banks want you to think. that a 30-year mortgage gives you flexibility, well, in reality, it makes you feel comfortable because there's always something else that you can spend an extra $600 a month on. And this is exactly why my wife and I decided to refinance last fall from a 30-year to a 15-year mortgage to force us to make those extra payments, as well as to take advantage of the lower interest rate of the 15-year compared to the 30-year. So just for fun, I'm going to see if it's worth it for me to refinance again after just refinancing barely 6 months ago. I just refinanced last fall from a 30-year 4.25% mortgage to a 15-year 3.25% mortgage with a $223,000 balance. My monthly payments are roughly $1,570 a month for the principal and interest, which will give me a lifetime cost of $283,000. And as of today, I have a $218,000 balance and 14 and a half years left on my mortgage. So my remaining lifetime cost from today onward is $273,000. If I refinance today to a new 15-year mortgage, and let's say I get a 2.85% interest rate, I might still have around $2,000 or more in closing costs, which if I roll that into the mortgage, my new mortgage amount would be $220,000, which would give me roughly a $1,500 a month mortgage payment and a lifetime cost of $270,000. So obviously 6 months ago, I wish there would have been a 2.85% 15-year mortgage available, as it would have saved me around $70 a month and around $12,000 to $13,000 in total lifetime costs. But refinancing right now would only save me around $70 a month and $3,000 over the next 14 and a half years. So for me personally, this amount of savings isn't even close to worth the hassle of going through refinancing. I hope this was helpful for you in determining whether or not to reach out to your mortgage lender or financial advisor to continue this conversation. If it was, and if you want to see more great content about all things related to personal finances, make sure you check out my channel and some of my other videos. So make sure you hit that subscribe button down below and the bell icon right next to it so that you're notified when I upload new videos, because I have a bunch of great ones in the works right now. Thanks guys for watching, and I'll see you on the next episode.